much, Chetan. Thank you, gentlemen. We come to our...
And lady.
And lady. Well spotted. Come to our next panel on return on investment. Core Banking ROI, Qualitative and Quantitative Outlook, moderated by my colleague, our Head of Research, Nikhil Gokhale. Plug yourself in, sir, please. And his panel is Balaji Viswanathan, the Managing Director and Chief Executive Officer of Expleo Solutions. Wootton, Co-founder and CEO of SaaScada. CEO of ABK and Client Advisory Board Member of AssistEdge, Edgeverve.
After a lot of talk and discussion about microservices and composable, finally the money panel.
Money. Show me the money. Yeah.
Show me the money, isn't it? So, perfect. Thank you so much, gentlemen. I'm going to start with asking why in the first place this panel. So, Somnath, you have done core banking transformations maybe for more than 2 decades almost. Yeah. You've probably seen it.
Unfortunately, yeah.
From infancy to now, NextGen, right? So let me ask this question, right? So is it important to have a transparent dialogue between the business side, finance side, and the technology side? One, is it important? And two, why do you think it's important? When you talk about ROI.
Yeah, so great question. And before I start, just want to say, my experience is with the old world, the traditional. Today what I'm hearing is all new gen. Okay, so when I'm talking ROI and things like that, I'm talking old world. And I am also a banker, not a technologist. So my view is maybe slightly different, but happy to take questions. So the first question you ask, absolutely important. Absolutely important that you take everybody on, because a core banking project is always seen as a technology project. Disaster. Because if technology runs this project, there is absolutely no way it will finish on time, within the cost, because everybody has an idea. So the first thing which, in my experience, has been done is that this project is not owned by me. I am just delegated to run this as the CEO, but this is owned by either the board or the CEO. So you guys want to come together, it's all together. Businesses always have a view, right? And most people have worked in other banks, so they come and either they hate a particular brand of technology or they love it. So then based on what their experiences are, you have to now win this battle of which brand to go for, okay? So it is a democratic process, very tedious, but in the final, when you start the project, it really pays off. Because if everybody feels involved and everybody has an input, in fact, we even take them on site visits, saying bring the business guys along. If they're going to site visits, let them talk to the business guys at the other end. And when you whittle down to 2 or 3 vendors, take them, because it helps. It takes maybe a little more time, but that time is well invested in the longer run. So that's step one. Step two, in the project, we make sure that we bring in everybody. And this is another big problem. Give me a best guy. No, I don't want to give me a best guy. But he's the guy who understands your business. But then how do I do this? So big argument, but we take the good guys and then make the project team. Again, makes it collaborative, okay? So that, and we say that this guy is the guy who represents your business. Any questions he has, he'll come to you. It works. The third one is, after the project is kicked off, again, collaboration. We started something which we call partner steering committees. Okay, and partner steering committees worked very well because, it's always very easy to blame the vendor. So you ask the project team, it's always the vendor's fault, right? So you give them a forum once a month to sit with their seniors, not the project manager's seniors, with us and say, okay, what are the issues? So open forum, you have issues with the bank, let us know, okay? And the idea is fix it here, rather than go back and come back after tons of emails. No, try and fix it here. Works very well. And it just brings in the whole sense of, this is one project we all need to succeed on. And obviously, vendors are interested as much as the bank in succeeding. So I think this whole thing about collaborating many times is overlooked. And I've seen other cases where businesses keep demanding because they were never involved in the process in the beginning. It's tech project. But they need to run the business, and then there's always a revenue opportunity somewhere which they're missing because you're changing the system. Okay, standard. They'll say, and no CEO can deny that or defy that, because you say, okay, then don't tell me my profits are down. So this is an ongoing argument, right? So best to bring them in from day one and make it a collaborative one. Not easy to do, but works wonders.
Makes sense. So having a common understanding of what is ROI and what does ROI mean, I think it's the first step of succeeding, of generating ROI. So before we get into the ROI, let's break it up and let's see, return on investment. Let's look at the investment side. So Balaji, often when we look at the investment, we should, we told that we should be thinking about it from a total cost of ownership point of view, right? So when it comes to total cost of ownership for a core banking modernization, or maybe it's a first time implementation, what are the typical heads, if you will, of the cost?
Okay, I'll probably add to what Somnath said and then get into this. It's of course important to have everybody, but more important than what Somnath started with, and that's what Supratim mentioned in the morning as well. Why are you doing the core banking transformation or whatever modernization that you want to do? That's more important, because only if you know the why, then after that, the return, or what is the investment and what is the return that you can expect, will actually start off. On the investment part, traditionally, if you were to look at what it used to be, because I have been a banker for 16 years before I moved into the other side, so I've seen the buy side and then now the sell side for the last almost 10 years or so. And if I were to look at it, the primary challenge used to be that what is the one-time cost and what are the recurring costs? 10 or 15 years back, the one-time cost used to be primarily around license fees, what's the customization, what's the kind of infrastructure that you need to set up. But more often than not, what I see nowadays, at least when we talk to our customers, is around how scalable it is. Can I actually build as it grows, rather than trying and investing everything upfront and then waiting for the return on investment 3 years down the line and 5 years down the line. And like Mark Jenkinson, who mentioned in the morning, the product life cycle has shrunk significantly from what it used to be earlier. So gone are the days where you invest on something and it takes 10 years and you can actually measure the return on investment over a 10-year period. Nowadays, the product life cycles are anywhere between 1 year to 3 years. And you need to actually look at your return on investment in that particular time frame, rather than trying and looking at a 10-year or a 5-year or a 7-year kind of return on investment. Traditionally, when you look at the modernization, it's around one-time investments and what the recurring expenses are, what's the proportion of license fee. It used to be, the license fee or the product fee used to be around 25 to 30%. The customization used to be another 25 to 30%. And then, all the other supplementary systems and other stuff that you need to do, whether it's a database or whether it's the kind of, applications that you need to integrate, that used to be the case earlier. But nowadays, that's actually flipping around. It's not the question of, it's the question of how well you're able to integrate, how soon you're able to integrate with the external systems, and how easy it is to integrate those. And that's where the journey is going. And picking up on what Robin mentioned in the morning today, 70% of the banks are still going to be on the monolithic system 3 years down the line. So we need to make sure that the return on investment caters to that specific segment, because you'll still have 70% who will actually measure on a 5-year, 7-year period, and you will have another 30% who will be measuring on a 1-year, 2-year period as well.
So, talking about those 30%, right? So I think my next question is to you. Nelson, how will the total cost of ownership change? And, I'm not just asking from a numbers point of view, but also from a thought process point of view when it comes to the implementations on the cloud side.
Yeah, it's very different business models occurring in this space now. So the NextGen guys are much more subscription-based much lower entry fees. So gone are the staggering £3-4 million 3-year projects to implement a new core banking system. That's an approach that isn't going to work. If for no better reason than by the time you finish that implementation, you're now 3 years out of date. Those cycles are so quick now. So it's a lot harder and a lot easier, right? So why is it harder? So with the NextGen guys, what you're seeing is people focusing on a smaller piece of the deal, all right? So traditional core banking systems have done everything from the digital banking and customer experience to the top, all the way through to products and ledgers at the bottom and everything in between, right? So the new guys are kind of focusing on a much smaller segment of that, a horizontal slice of it. And their business model is much more subscription based, okay? And the concept behind that ultimately is a better aligned business model. So as you, the bank, grow and succeed and build accounts and build value, your supplier's growing and succeeding with you. And that it's a really clever model because it keeps everybody aligned. It's not about getting a project over the line, it's about building a long-term partnership. So the drawbacks, though, right? Yeah. There's a lot more players in the space. Okay, so we're dealing with we might be dealing with card processors and payment integrations. We might be dealing with CRM and digital banking. Right at the table of my digital transformation might be 8 or 9 different suppliers, not one. And that in itself brings its own challenges. Yeah, and I think the idea of getting these projects up and running fast at low cost is at the very heart of what the NextGen guys are all about, right? It's all about get your toes in the water, try it out. It's a low cost model to get started with. And the projects that we see that really succeed in this space are where there's a specific product or a specific thing that the bank is focused on achieving, and they go, right, it's too hard to do this with my infrastructure, let's stand something up alongside it, and then that ecosystem builds and more stuff comes off of the big cruise ship and the little speedboat alongside it. More and more people come over, and slowly it becomes a bigger and bigger entity and a full-blown ecosystem.
Nelson, I'm going to pin you down here a little bit. Let's talk numbers, right? That's what will get people excited here. So if I were to talk about numbers, what would you say is the percentage in terms of the cost savings, or what is the investment that you would have on a cloud versus on-prem over a period of, let's say, 5 years? So is there a real cost saving?
Oh, undoubtedly. But I think I am going to answer the numbers, but I think you have to, sorry, I'm not trying to be slippery. I think you have to think about cloud as being a new operating model. It isn't just the same operating model moved somewhere else, and if it is, you're not going to get any of those benefits, okay? So the idea of cloud ultimately is to try to decouple what your infrastructure hardware away from the software that you're operating to allow you to scale and change faster, right? So when I want to launch a new service, I just stand it up on the cloud. I don't go to IT and procure 7 new servers and load balancers and all sorts of infrastructure that has to be signed off and then amortized and written down over the next 3 years, and all of that kind of stuff just goes away, right? So you've got to really start changing the way you think about it, which is, I'm going to try this, I'm going to turn it on, and if I don't like it and it's not working, we heard a lot of this kind of A/B style testing, turn it off again, right? Get rid of that cost and move on and try something else. Right, splitting it down, I think, your kind of total cost of ownership, typically we're seeing core systems sub $1 million over a 5-year period, right? These NextGen guys are operating in that space.
Say the number again?
Sub $1 million over 5 years.
Whoa.
Right, fractional costs, right? Really low cost implementation fees, sub $250,000 to implement one of those platforms, and then they are basically charging you per account, per month for maintaining those systems. It's a completely different world. It is so different from the kind of stuff that's been happening historically. And because of that low cost model, it is enabling organizations to innovate and try new things, and that's the real power.
you wanted to add something?
Yeah, actually, like what Nelson was mentioning, it's not the question of, what's the investment and what's the cost save. It's the question of what's the agility that it brings in, how fast I'm able to actually roll out the product. Somebody was mentioning about, fail fast. If you were to try something new and if you were to actually invest a couple of millions and then try and fail, that's going to be too expensive for you. So, the new age technologies and the new core or the new model of core actually enables you to try new things at a much lower cost. And over a 5-year period, if you were to look at the total amount that you have spent, including the subscription fees and other stuff, it may not actually show a significant difference. It will probably be 20% lesser or 15% lesser. But the ability for you to grow the business, because you can't look at it only from a cost perspective. It also depends on what's the kind of revenue that you've earned, what's the new customers that you've added, what kind of new portfolio you're able to bring into the market. So you'll have to actually measure it with that. So some of it is qualitative, some of it is quantitative. So
I think it's also about the risk, right? You're taking a lot lesser risk by not committing, upfront such a large investment.
Well, not only financially, but you really, a traditional ROI is we're going to start a 3-year project and we hope this is going to happen at the end of that 3-year project, right? When you move into cloud and you're really breathing that, you don't think in 3-year cycles. You're thinking in 3-month, 6-month cycles, right? And you're trying new things, and your investment up front is going to change, and your objectives as a business are going to change. And the ability to make those changes is what you're really buying when you go into the cloud.
Interesting. I think we are certainly starting to veer towards the cloud implementation. But I'm going to bring us back to the original.
Cloud is only the infrastructure. Cloud is only the infrastructure.
Exactly.
Software as a service is what is more important.
Exactly. No, but I'm going to, since I started with the ROI, the I part, let's talk about the return part, right? So, when you say return, of course, there's a lot of qualitative benefits that are very hard to quantify. So I'm going to start with the qualitative side, and I'm going to ask each one of you to maybe give us ideas of how to quantify them. If you can, give us some thoughts around that. So let me start with you, Somnath. So what would you say are the benefits?
At the outset, I need to say one thing. Something like this in banking, one size does not fit all, right? So I think Ram said that in the morning. I totally agree. One size of the bank. So new banks, very easy to do, because they have no baggage, okay? Existing banks, the bigger they are, the bigger the baggage. So to get something done like this is a huge leap of faith at times. So most banks, as you know, don't do a big core banking change if they can avoid it. Because either the CEO or CEO says, not during my time, I'm here for you. Let the next guy do it. And then when that thing is about to crack, so the why, most of my experience when the thing can't handle it anymore is when they say, okay, let's do something over it, okay? So qualitatively, and I get asked this question everywhere, what is the ROI for core banking? To me, core banking is infrastructure. If you do not have a solid table, you can't build on it. Now you want to bring in new products, APIs, all of that, you don't have it, you can't do it. So I keep telling them, it's not return on investment, it's risk of ignoring. If you ignore, what are the consequences? You will have huge errors. 900 million can just fly out of the door. We saw that, right? You can have huge issues about not being able to compete with the market because you need APIs, you need integration, but your old thing doesn't allow you to do it. And the third thing is hacking. Okay, you are extremely vulnerable. And now today, every 16-year-old kid just does that to pass time to see, can I break into a bank? So when you have all these kind of motivation, okay, and you say, you still want to stay with your old system, that's when the whole thing becomes, okay, this is not just about return on investment, this is about survival. You want to stay in this market, you better change.
Yeah. Makes sense. Absolutely makes sense. So when we, again, anything that you would like to add when it comes to return. So you mentioned that, it's about the revenue or the opportunity cost almost.
Right? Absolutely.
So, not being able to serve.
It's risk at all three levels. It's risk of making huge mistakes because the system allows you to. Modern systems are much more well integrated. You have checks and balances. Plus, you have patched the system like 16,000 times, so it's lost all its qualities anyway, right? Secondly, it's missed revenue opportunities. So the market is flowing on, getting new stuff in, and you're still sitting and plodding, okay? And the third one is, I am a big believer in cybersecurity being not just a hygiene, but should be the most important thing any bank worries about, because overnight, it's not just the money which goes, it's a reputation, right? You get hacked once, you get hacked twice, everybody's like, okay, we don't want to deal with this bank.
Anymore.
Completely agree. So Balaji, I'm sure you would be getting this question when you go and make a sales pitch. What's my business case for the core banking solution? So how would you break up typically? So obviously, if I were to create the two biggest buckets, one would be the revenue increase that you can get through a NextGen core. It's also about the cost savings and the customer experience. So how would you say that you help create the business case for your clients?
And I'll probably pick on what Somnath mentioned earlier. It's not one size fits all. So it's not something which you can say that if there is a small bank with a less than 1 million customers who are actually looking at a core banking solution, or I wouldn't say core banking, a product processing solution, as what we'd probably try and rip it down to. Their business case would look very different compared to the larger banks with multiple geographies and with millions of customers, and that's where the risk of not doing the modernization is very, very high. And the new age banks, smaller banks, credit unions, the ask is very different than, they are all region specific. So each one of them will have, a different business case, so to say. So the business case will have to be broken down into saying that, why am I doing this? Is it to try and solve my current legacy problem where it's not able to scale up, or whether it's not able to allow me to launch new products because of which I'm actually getting into a modern system? Or is it because I want to now make sure that I'm competing with the fintechs and the new age banks, and I want to actually go down that particular path? So the business case will actually differ between the two. The growth in business and others are, I would say, I'll steal Somnath's words, leap of faith. So you're going to expect that the growth in business is going to happen. But for that, the time to market is important, because the growth in business is going to be based on how fast I'm able to implement as well. So when you're going into a new core banking or a legacy modernization system, the biggest challenge is the time, how soon you're able to implement. And if that is going to take you 3 years, or if that's going to take you 2 years, and I have seen those examples, of what Somnath mentions, where the program actually planned for 1 year and still runs for 3 years and still not seen the light of the day. So that's going to be another crucial element as well. How much you are ready to sink in to go through that particular process. So it depends on why first, and then after that, the question of return on investment.
And the type of bank you are looking at.
Yeah, it's one size certainly doesn't fit all.
So, how would you say, does it differ for a digital bank?
Inherently, digital banks tend to have less baggage. It's a good term, baggage, actually. I quite like that. We encourage people, when you move house, right, there's this sorting process that you go through, and you get rid of loads of stuff that no one's touched or used. Yeah, right. And I think banks need to be encouraged to have a think about the business process they're going through, coming all the way back round to the original point, right, which is, why are we doing it the way we're doing? This is a legitimate question to ask. And anyone who says it's the way we've always done it is, red flag. Right, oh my God, hold on a second. That cannot be your reason. So, that doesn't really apply to digital banks, right? A lot of these guys may or may not have experience of banking, but they don't have any of that baggage. And in fact, they're really only focused on one thing, and it was a point that was touched on previously: execution, right? get it done. Actually, get it done fast, and I'll throw a couple of things away if I need to get it done fast, because getting it done and getting it moving and gaining data, another point that we've touched on several times here, using that data to fold it back into my product and understand what I need to change in order to engage customers. Digital banks do that inherently, right? They don't, it's in their culture, it's in their psyche. Whereas traditional banks don't always think like that. They're getting better, though, don't get me wrong, and they're playing catch up, and they recognise this change. But there's a big difference there, and it is the baggage, and sometimes it's the ability and willingness to recognise what can be thrown away and changed and what can't.
And if I may
just add to what Nelson said, the reason traditional banks are now moving is they're seeing that the lunch is being eaten by somebody else, right? So now if you don't do anything, fintechs will take you over completely. So now you need to move something. But again, it's a behemoth. This is a warship. It can't just turn like that. It has to take time turning. Has to consider so many other factors. But the fact that even traditional banks are considering it, my belief is, you may not exist. So you might as well start making the changes. Otherwise, the dinosaur example, clawing away and eating the flesh. If you don't recognize somebody eating your flesh, you're soon going to be, completely out of the marketplace. So I think that was a very good example, and that's why I think traditional banks have started doing it. Not that they wanted to get into the fintech space. They definitely don't have a thinking of the digital views. They don't have that.
So, actually, you already started answering the follow-up question I was going to ask, which is, do you think the whole conversations of ROI and just getting approvals and all that has changed? When it comes to the traditional banks, has it changed, and is it easier now to just literally go ahead and making that case?
I don't think it's easier. I think it's still as challenging, but it's there feels like a much shorter decision-making cycle and number of people in that chain in order to get things pushed through. One of the things that came out of COVID, and again this was touched on previously, is it's perfectly possible for these organisations to move quickly. They can, if they must. And the fintechs are applying pressure to these organisations and will continue to apply more. Those that survive are going to respond to that pressure and make decisions faster.
What I'm hearing is that it's not the conversations have become easier necessarily, but they've definitely become faster.
Impetus now, right? Real impetus. Impetus for change. They want to do something different. They recognise they must do something different.
Sense. Yeah. So, Balaji, I have a question for you. So, if you think about a classical modernization project, you could take a big bang approach, or you could take an incremental approach. So, of course, there are benefits and challenges of each, right? But in today's parlance, given the ROI lens that we are having right now, what would you say is the difference, and where would you say is the ROI argument stronger between a big bang approach versus an incremental approach?
See, whether it's big bang or whether it's an incremental approach, it's the question of there is really no second chance. You have to get it right. Don't have a choice. And if you want to get it right, it depends on how much of the pie you will be able to eat with the the size of the mouth that you have at this particular point of time. And if I were to look at that as the lens, for the larger banks, for a legacy modernization with a lot of customers, existing businesses, it's always lesser risk to go on with the incremental approach rather than going with a big bang approach, because you are impacting, if it fails, then it's a much bigger fail than what you try to do in an incremental approach. The other downside if you go with an incremental approach is, you start with only one particular part of it, and after you finish, then you start the next one. If you were to do that, that used to be the traditional way of doing it earlier. You finish the first sprint and then go for the second one. That's not valid any longer either. So you'll have to start almost everything together or slightly behind each other. maybe the finish line might be different and the finish line might change depending upon how the first one finishes. But you can't really have the model of saying that, no, I'll wait for the first one to finish for me to start the second one. You need to try and build that, the return on investment based on the time to market, based on how you start the sprint. And everybody talked about it in the last 3 panels as well. Gone are those days where you start with something and then wait for 6 months or 9 months for you to, get to see whether it is going to happen or not. Nowadays, everything is on a 2-week sprint or a 4-week sprint at best. And you would know whether it is going right or not going right, during that particular cycle.
Almost sounds like, a combination of, a big bang approach and a incremental approach. You can't
need to marry
do one
between the
or
two.
the other. It's about
Yeah.
doing both almost simultaneously, but with some time.
Some
delay.
subtlety, yeah.
To add to that, see, banks, the bigger the bank, the bigger the problem, right? So I used to work for Citibank. To do something in that bank, it takes time because the process is long, the number of people to approve, and then they got to think of which countries, which businesses. It is a lengthy process. Again, you could decide whether you want to go big bang or you want to go incremental. Most such cases, it's incremental because the risk of doing a big bang is humongous. Whereas when in the banks which I worked in the Middle East, my preference was big bang because you get it done, it's an operation, move away. You can't have this surgery going on and on. You want to get it out of the way. It works well if you have the full cooperation of the team and you can do this. Otherwise, it can be a disaster because you said 6 years. There is a bank which is a very big bank which is still doing it for 10 years and haven't got it right. And they're draining money. So the ROI is out of the window.
Yeah, I think that's a fair point. There isn't a killer approach, right? Incrementals can go wrong as well for the same reasons. Actually, in reality, I don't think the reasons those projects go wrong, scope creep, changing things, or actually it doesn't work like that, it works like this. All of those things come up through those projects. The ability to make decisions fast is critical, though. That's the thing that these organisations have to get in there. When you're talking about 2-week cycles, it means your project's going to have some progress in 2 weeks and some questions, and they need answering. And if you don't answer them, that project's going to start stalling.
Or somebody has to answer. Somebody has to take the ownership to answer.
Yeah,
I think it's going to help, the whole concept of failing fast, right? That's going to
absolutely.
It's not about failing fast. It's about finding problems fast. Absolutely. So, all right. So I have one question, which is I'm going to ask all the 3 of you. So you need to tell me the 2 challenges that you think that could either one delay the the ROI or the time frame that you expect the investment to recoup. So what are the 2 challenges? And if Somnath actually identifies the challenge that you have in your mind, then you'll have to come up with a new challenge.
So you basically need 6 challenges.
So, okay, I had 3, but I'll give you 2.
Being nice to
The first challenge from the bank's point of view is this whole requirements document, the RFP, disaster. Because if you ask the business to write an RFP, it's like, everything in the old system, I want it here. But you can't give it a vendor and say, everything in the old system, give it here. So you need experts like Siddharth to come and write it for you, right? So you need to do that, and most people don't see it. They say, we can write the RFP ourselves, it's our own bank. I don't think it works. Because this cost increases, because then you tell at a certain stage, 6 months into the project, you tell the vendor, but we wanted this. He says, but it's not in the RFP. The whole thing starts, which is the next bigger problem, customization. I hate the word, okay? Because everybody wants to customize the new system. And what are they customizing? Mostly what they had in the old system, right? Because they say, this thing comes from the right side. I used to get it from the left side. Does it work? It works, but I like it from the left side. Customization. And again, you need to take a very hard look on this. Otherwise, customization can drive you crazy. Not only the time which you spend now, when the next upgrade comes, the customization is unique to you. So you're going to get charged for it. Upgrade is covered by the license cost, great. But for this, you need to pay extra, okay? And that is a huge cost, which you don't realize, but 3 years down the line, somebody gets hit with that. So these are two things which I always are very particular. If you have these two, if you have the RFP right, and you can curtail the customization, then you're at least on the way to a good project.
So I'm going to...
Did you get the third one from him?
No. I'm going to wrap that up a little bit, though, in what I'm going to call clarity of purpose. Okay, so it is absolutely critical. Why are we doing this? What are we hoping to achieve? It's where every ROI conversation starts, right? So there has to be clarity of purpose all the way through. And then, and the second part of that links very nicely is the ability to make decisions fast. Right? We're in an agile world where iterations are happening on a weekly basis. You need to make a decision in the context of the clarity of purpose. Why am I making this decision? How does it help me get to the place that I want to get to? Does it help me get to the place? And that has to happen again and again and again. As soon as you deviate from that, it goes off the rails. As soon as you deviate.
The first question that I asked was about clarity of purpose and having everyone on the same page. So clarity of purpose and agile decision making. Makes sense?
So I think Nelson stole my first point. So I was actually about to say why, because that's the most important element. The other bigger thing is that we need to have one owner or one sponsor for the program who will take the decision after 2-week sprints or 4-week sprints or whatever you want to call it as, depending upon the size. Who's the sponsor? Who's the owner? Because every point you will have some decision to be made, and if that decision is going to be on a democracy, and if it is going to go around the table for 10 different people to take the decision, that's not going to happen. And if you want to do it in that 4 weeks period, that's certainly not going to happen in that 4 weeks period. So you need to have somebody to own the project and take the decision on moving ahead. And the other element is that, do I really need to do this modernization in this system, or can I actually try and, with so many technologies available and so many product processes available outside, do I really need to do this in this particular system, or should I leverage something else beyond this?
Having knowledge of all the options that you have in front of you.
So that's where the talent or the knowledge comes into play. Your earlier point on as the decision making become much faster, I would say that if you look at the larger banks, at least I can name the top 8-10 global banks, all of them have a startup ecosystem nowadays, which they sponsor, which they have built on their own, primarily to drive this, innovative ideas. They know that there are some things which they can't do it on their own, so might as well have a startup ecosystem which is going to feed them, this particular, knowledge and perspective.
Perfect. So, I think you need to have an owner, and the owner is the one who has to drive consensus.
Absolutely.
I think that's
consensus or
at least making sure everybody.
Or become an autocrat or something. Forget democracy for a change.
At times you need to forget democracy.
Perfect. I think, with that, I think I'm going to open it up for 1-2 questions, if there are any. Let's go around the room. Everybody's made money.
Or everybody is trying to make money.
Oh, of course.
We were speaking a bit about the cost at some point, and I believe, Nelson, you spoke about implementation costs, and you said 1 million over 5 years. That was implementation. But how about license or whatever? I mean, if each of you had to throw out whatever, because we know price and ROI is based on, you have to get quantitative at some point because you need to actually make a payment. There's a payment schedule to, a vendor selling something. But the thing is, obviously, it's always hard to gauge the scope, right? So what's the price for what scope? Because anyone in that industry does everything, but what is native within the IP of the vendor, what goes to third parties, and what is next integration that is not yet done but will be done, right? So how could you just literally throw out a bit of your thoughts about how you factor in cost when, you want actually that ecosystem, that someone carries kind of in a way, which is maybe the core banking vendor. But
So,
See, I told you, the numbers will get people
no,
interested.
you're correct, right, yeah. I guess, look, it comes at scale, doesn't it, right? So, as a bank is bigger, more accounts, more cost, more infrastructure, For me, when I think about cost and I stay focused on it, when I stay focused on it, I'm trying to, what's happening in the world, in this world at this moment, is that service providers becoming more focused about what they do and what they don't do, all right? And what that should allow an organization to do as they bring the ecosystem together is eliminate unknowns. And one of the big challenges with big projects is there's lots of, we'll kind of figure that stuff out, and figuring that stuff out can sometimes be staggeringly expensive. And so the flip side of this kind of ecosystem approach is that you want to bring each partner to the table with a very definitive service structure about what they are and aren't going to do, and you shouldn't then have gaps. And it's the gaps that get runaway projects going.
And to add, I think that's a very good question.
RFP that you mentioned.
Exactly, the RFP, and very good question, because scope creep is a nightmare, right? And if you do not scope it out in the beginning and you keep asking for more, it's the same thing. It's like customization, it doesn't stop. So 1 million is like, I would love to see it within 5 years, but that's modern technology. The ones we are used to is multiples of that, and it takes 36 months.
Hi, hello. I want to ask, how is this core banking and ROI related with the cost of running this in the cloud? Because we see everything is going to the cloud. And I remember all banking systems running in host, how expensive is running in the host, scaling host, and also how expensive is for banks running open banking, because now they have to pay host computing for other third-party companies requesting data of the users. So what's the role of the cloud vendor here? And is there any difference going through one of another? Thank you.
Okay, so let me start by going, it comes a little bit to the previous point around that service offering. So most of the next-gen core guys, your cloud costs are going to be included. Not all of them, but part of their package is going to be, you don't think about this, right? You don't need to think about the infrastructure anymore. You're not going to be spending time and cycles maintaining it. You're not going to get up at 3 o'clock in the morning because a hard drive's failed. That is my responsibility as a provider, and it's included. Is one cloud better than the other? No. They have slightly different SLAs, and they've all specialized in slightly different ways to attract customers. So Google's very good at big data plays, and if you've got big data analytics programs, AI, machine learning, it's an incredibly good place to do that. Azure, well, Active Directory. I mean, almost every organization in this room will be hooked on Active Directory. So an awful lot of internal infrastructure is all going to be run in something like Azure's cloud. AWS fills the gaps in between those two. So, we are seeing typically joining 2 or 3 different cloud providers together in every single project. And each one is being used for its strengths, which is the beauty of the ecosystem.
It's amazing how the ROI is starting to go towards cloud.
And
No,
it's infrastructure.
It's absolutely right. So I think that's the direction of where the world is moving to.
It's primarily the infrastructure, and to add to the point, it's the question of if you were to do everything on-prem, if you were to have a host, if you were to do all those investments, the problem is the scalability. So I can't really buy a system with terabytes of processing capabilities and then expect that after I add another 500,000 customers, I need to add another 1 more terabyte. I would rather go with a model where it's scalable, which will actually, if I don't grow, then I'll be able to manage the infrastructure that I need. If I grow, then I can always add on demand.
One more question.
It's an open question about system integrators. No, traditionally, Accenture, Deloitte, all these players. Actually, they typically were the largest bill to pay, even much more than the traditional core banking vendor. So, with this all changes, how do you see their role evolving? Obviously, I'm sure they are trying to stay relevant and to add value to their customers, keep their business. Just one open questions to share your thoughts on this.
Okay, I'll go first. So, if you're going to Deloitte, let me know. I'll give you my card. You can come to me first. So, from what I could see, the entire consulting engagement on trying and figuring out what fits you better, primarily because, like what Somnath mentioned, where is the requirement and how the requirement has to be put together, because that's where the drawing board starts. And for that, you need to have an expert, because you don't have one expert within the organization to say that I know everything within the bank or everything within the organization. So for that, you need to have an expert who can actually come and sit with you, because you're running your business. So obviously you don't have the time to take people out and document all this requirements. So for that matter, you certainly need an external help. If you're a large organization, if you're a startup, you always obviously know what you want to do. So at that particular point of time, it's only for trying and figuring out whether AWS suits you, or whether it's Azure suits you, or whether it's Google suits you. But beyond that, that scope actually changes depending upon what is the type of the implementation that you're going to do. And
do you see them adapting to be as fast as we have discussed that they need to be? Because they also need to kind of.
From where I sit as a banker, technology companies, the core banking companies, are now giving you a whole bank in the box, right? So integrators are not necessarily always required, because you can do everything. You can do your trade finance, you can do your treasury, you can do everything from this box. Then I have only one party to interact with, one partner to work with. They do the whole implementation for me. The disadvantage of that is I don't get necessarily the best product. Okay, so they give you something which is all there, but that's not the expertise. But if I want to go to payments, I should be going to the best in the market. Now, from a cost perspective, that may not be very beneficial, but from a service perspective and a customer benefit perspective, it's better to go to the best product processor.
Perfect. Sorry, you go ahead.
I think I'd be worried if I was a systems integrator, frankly. When we talk about the ecosystem, what's really super interesting about the ecosystem is each partner in that ecosystem is motivated to integrate with the other partners, because it helps deal flow. All right. So one of the challenges you'll have when you've got 8 people around the table in order to do a banking deployment is there's 8 organizations that need to move in sync with each other, and they're absolutely motivated to get those integrations up and running and proven. And that's starting to take some of that systems integration work away.
Interesting. And every time Robin stands up, it means that
time is up.
Time is not just up, but beyond up. So it's thank you so much, gentlemen. It was a pleasure having you.